So what the heck are options anyway? What's up, my milk money millionaires? I'm Joshua. Welcome to my channel where we learn to milk our money to make more money. And my favorite way to do that is through using options. Options trading has been hitting record levels as retail investors dive in. Maybe you've heard some of the buzz and you'd like to get involved as well. Well, you've come to the right place because at Milk Money, I'll be having a series on options basics as well as sample trades. So like this video and subscribe to the channel to get more on how-to videos in this series as well as future trade and investment ideas. So first off, we need to talk about what an option is. In this video, I'll explain the basics of options and go over some of the key terms and concepts to get you started on this journey. Basically, an option is just a contract or deal you make with somebody to either buy or sell a certain stock at a certain price at a certain time. When you trade options, you aren't actually buying or selling the stock directly, you are locking in prices for a stock later. Kind of like getting a rain check at a store or putting a deposit down for a pre-sale. So let's say you put up a car on Craigslist for like $5 grand and your friend says that they actually want to buy it from you, but they can't until they get paid at the end of the month. If you wait for your friend to buy it, you're risking that the value of your car goes down and you have opportunity cost as you let your car sit there unsold while you wait for your money. So he says, you know what, I'll just give you $100 to sell it to me next month at $5 grand. And you say, okay. You get paid to wait on making the deal, and he pays to set up the deal for him in the future. You just made an options contract. So let's go over a few basic terms related to options and how they function. First off, an option contract gives you the right to buy or sell 100 shares. The price of an option is listed as the price per share, so you have to multiply the price times 100 to know how much the overall contract will actually cost. Second, you can buy or sell options. If you buy, you pay to enter the contract. If you sell, you get paid to enter that contract. We'll talk more about buying versus selling in future videos. Next, you have a strike price. This is the price for when the option contract or the deal will actually take effect. For instance, let's say you have a $25 stock and you create a call option for $30. If the stock never hits $30 by the time it expires, it ends up as a worthless contract. If the stock price goes past the $30, then it will be considered in the money and the contract will be executed. The last basic piece of a contract is the expiration date. This is when the contract ends and either gets executed or thrown away. There are contracts called weeklies where they expire at the end of the week, as well as leaps, which can be over a year, and all sorts of time frames in between. The longer the contract time, usually the higher the price because you are promising to stay in that deal for much longer. Therefore, you need to get paid more or pay more to keep that deal going. There are two types of options contracts, calls and puts. We will be making videos on each one of those individually, but for now, let's go over the basic difference between the two. When you create an option, you are making a promise to buy or sell later. Puts versus calls are basically whether or not you are making a deal to buy or a deal to sell. Calls allow you to call away taking or buying somebody else's stock. A put contract is the right to put your stocks in somebody else's account. You are able to sell your stocks to somebody else at a certain price with a put. A call is kind of like a rain check where you lock in a price for later because you think it will go up before you get the chance to buy it. A put is kind of like insurance. I don't want to sell my stock right now because I think it's going to go up in the next year, but I'm really afraid of a market crash. So I can buy insurance and keep my stock. Let's say the stock is at $10. So I buy a put that says I'm allowed to sell that stock for $10 anytime that contract is good for. If it crashes to 5, I get to sell my stock for 10 and I get to protect my portfolio. Of course, you have to pay somebody ahead of time to be able to do that, just like you would buy insurance. Now, the difference between calls and puts might still be a little confusing, and that's okay, but subscribe to see my in-depth explanation of calls and puts in the future. But for now, we're just focusing on the big picture and the vocabulary. So what's left? We need to know how options are different from stocks and why people would use them, as well as what the unique risks and rewards are. So why do people use options? At Milk Money, I love using options as a way to make income by selling options, either against my cash or against my shares. This is a fundamental of the Milk Money way. The most popular use for options is for speculating with leverage and less cost. If a stock is $100 and you want to make a bet it will go up, you would put $10,000 into buying 100 shares, and you would make, let's say, 10% if it goes up to $110. Instead, you could buy an option for a lot less that would lock in those same gains. Using options gives you leverage in this scenario because you use less capital for a similar return. This leverage works both ways, however. So you can lose way more money when the stock goes down as well. Leverage is one of the main uses for options, but again, be careful because leverage is where a lot of extra risk comes from. Lastly, options are used as a hedge or protection against your portfolio. You could buy puts to protect you on the way down, buy calls to allow you to play the market going up while just keeping your money in cash on the sideline, or you could even sell options to lower your cost basis or make income on stocks that you already own. Lastly, let's talk about pricing and volatility. What is really cool about options is that they use a combination of probability and risk to determine the price, and the relationship is pretty reliable and constant. So you can actually just decide how much risk and reward you want to take before entering in an options contract. An option is priced based on two main factors. The first is the intrinsic value, which is the in-the-money portion of the option. If you have a call allowing you to buy a stock for $5, for instance, and the price of the stock is now at $10, then your option is automatically worth at least $5 because that's the profit built into your contract, because that's the difference between the current market price and the price you get to buy it at. Second factor is the premium, or the juice that's added to the option based on the risk involved. The risk is determined by the volatility or anticipated movement and uncertainty of a stock. A high-risk stock or a highly volatile stock will have very expensive options, while a low-risk sideways do-nothing stock like AT&T has insanely cheap options. No one wants to buy flood insurance in a desert, but if you live next to a river, you're going to pay a lot more, for instance. If a stock moves a lot, then people will pay more to lock in prices than if a stock doesn't move at all. Understanding volatility is the most important element of playing options. If a stock is quiet and has low volatility, you might buy options hoping that they're cheap and that when volatility comes back, you can make large profits. Volatility also creates a weird side effect, where you can bet properly that a stock will go up, but your option can go down because volatility decreases, even if the stock went up and you were right. If you think volatility is really high temporarily, you might sell an option, for instance, to take advantage of that volatility. I will have more videos on the art of selling options soon, so subscribe. So lastly, let's talk about the risks with options and how they act a little differently than stocks. When you buy a stock, you basically have a 50-50 chance it goes up or down. If you buy a stock, you hope it goes up and you make money. Easy peasy. With an option, if you bet that it goes up, you have to be right that the stock goes up and that it goes up by the time you say it will, and it will go up with enough velocity to keep that volatility premium in the options price, which means you actually have to be right in 3 ways in order to make money off buying options. Much more risky than buying stocks. However, with the milk money style of selling options, you actually take those same factors and do the opposite, and it makes those things work for you. So you actually get a higher percentage chance of making money. So again, subscribe to make sure you get that knowledge in the future. So anyways, thanks so much for watching and getting through this intro to options. They are very confusing for most people in the beginning, so don't worry if you're still a little confused, but if you practice a little and get used to them, they actually get demystified pretty quickly. So stick with them and stick with Milk Money to keep learning more. Again, I'm Joshua. Thanks so much for watching, and we'll see you in the next video where we learn how to make our money, make more money. The Milk Money way. All right, peace.